Summit Assets Group. Lori Graymont is with us, CEO and founder of Summit Assets Group. Lori's also the host of Real Estate 360 on the Wall Street Journal Radio Network. Lori, thanks so much for being here today.
Charlie, thank you. This was a great opportunity.
And we're going to go ahead and get started. We've got a big group here today. So again, if you didn't hear what I said earlier, we're going to take questions at the end of the webinar. If you look to the right of your dashboard on your panel, you'll see a button that says questions. If you click on that, you'll see a drop-down screen. You'll be able to type in your questions. So at the conclusion of the webinar, we'll be happy to take all your questions for you. And don't be shy to type those in as we go through the webinar today as well. What I'm going to do is I'm just going to do a really brief, it's 8 or 9 slide, just kind of an overview on the current state of the housing market. If you're not aware of what's going on in the housing market, as we all know, we saw the bubble burst back in 2008. It's been an interesting ride since then. Just some statistics to kind of bring you up to speed where we're at. This is Case-Shiller one-year price gains through March of 2013. Phoenix is up 22.4%. San Francisco, where Lori's based out of that area up there, 22.2%. Las Vegas up 20.6%. Atlanta, which is the market that Lori focuses on, we'll be presenting on today, is up 19.1%. Detroit up 18.6%. LA and Orange County, if you live here in this area, I live in Orange County, is up 16.6%. Interestingly, Orange County was rated the #1 most overpriced real estate market in the nation, which is nice to know since I live here. But this was from the Orange County Register just this month. Yes, home prices are up double-digit rates, but big deal. They are still way below the previous peak. We're going to talk about some of the institutional investors that are in this marketplace at the moment and why they're here. But if you can just Google this current state of the real estate market, you'll see lots of information out there about. This was in Forbes, I believe, actually just about a month ago. Home prices are up in the largest city, increasing at rates not seen since 2006. 9.3% increase over the last 12 months, dating from February to February. Most of what you read now about the housing market is that it's improving, that it's a good place to invest. There's lots of institutional money in the market. This is from the National Association of Realtors. Existing home sales jumped more than 9% in 2012, and that's the largest increase we've seen in 5 years. And here's the interesting part, and home inventory levels hit a 5-year low in 2012. We're going to talk a little bit about that today, why home inventory levels have dropped. Lori's going to be talking about, again, her chosen market, the Atlanta market, what's all going on there. That's one of the more dynamic markets in the country. But interestingly, yes, inventory is shrinking. Again, National Association of Realtors, 84% of agents believe that real estate values and number of real estate transactions will increase in 2013. 77% believe the new construction will continue to increase. This is interesting. 74% believe that their local economy will improve in 2013. That is an amazing statement as far as I'm concerned. After we've been through the last 4 or 5 years of fiscal cliffs and the challenge we've had with the dollar and the challenges in Europe, most realtors believe that their local economy is going to improve and that no market is expected to see a decline in home values or real estate transactions in 2013, so that there's much optimism in the marketplace. We saw 1/3 of the markets in 2012 saw a decrease in values in real estate. We believe this is a great time to be in this market. We'll talk about why that is as we go through the slideshow. If you're not aware of this, that the housing market is becoming something for the institutional investor, for the private hedge funds, for the larger investors that have come into the marketplace buying foreclosed homes in record numbers, turning them, doing some rehab work, renting them out, creating a rental portfolio of cash flowing real estate. And there's lots of reasons why that is, and I'm just going to throw a couple things out as we go through the slideshow about why we're seeing these institutional investors in the marketplace. Actually, I believe it really sort of started out about 15 months ago when Warren Buffett was interviewed on CNBC, and he said, hey, if it was practical, I'd buy millions of single-family homes. And then he went on to talk about how he wasn't very handy and didn't have the ability to be able to fix them up and do the things that were needed to be done. But Warren Buffett, being Warren Buffett, saw the fact that it was a good place to be, that real estate is a solid investment right now. And so he went out and he bought Prudential Real Estate. So now Warren Buffett, as part of his investment portfolio, owns a real estate company. And we believe that's where it started. You talk to these hedge fund managers, and yes, we do deal with them pretty much on a daily basis. You talk to them, you get a pretty good idea what their strategy is. And there's lots of reasons why they like being in this real estate market. I think the primary reason is they see it as the safest place to have your money. Essentially, real estate is a commodity that provides cash flow, and it's in a market now that's going to appreciate. Most markets, as we just saw on the previous slide, most folks think that whatever market you invest in, it's going to appreciate. Blackstone, if you don't know who they are sort of the 300-pound gorilla in our marketplace. This is a statement from Steven Schwartzman in October on an earnings call. They said they were buying $100 million of homes per week. So that's a pretty big number. We have had some interaction with Blackstone. They're only one of, we believe, to be about 47 hedge funds that are currently buying real estate in this market today. And so, one of the questions we had to ask ourselves was, going into 2013, was this a good or a bad thing? What does this mean for our industry? You've now got individual investors buying onesie, twosie homes as part of their investment portfolio or retirement portfolio. And then you've got the institutional investor now competing with us at a very large level. So was this a good or bad thing? So I found this article. This was, I think, in February of this year, and I pulled this off, and it actually cited 5 reasons why the individual investor should hug a hedge fund buyer today. And I pulled off 3 of them that I felt were the most relevant, and here they are. Number 1, hedge funds are driving up prices. There's no question about it. We're seeing an increase in home values across the country, and that's partly due to the fact that you've got institutional investors buying large blocks of homes. But the second reason is that they're buying undesirable property. They're buying homes from banks, in many cases, REOs, foreclosed properties that have been vacant for some period of time. And they're buying homes that have been maybe vacant for 3, 4, 5 years. And so therefore, they're buying these types of homes that typically a specialized REO group, like a Summit Assets group, wouldn't typically buy those. They do more, and I'll let Lori explain her process in a bit. But typically, a specialized REO group will buy, they'll cherry pick. They'll find the best properties, the best values, fix them up, knowing they're going to get the best rates of return. Hedge funds, on the other hand, are looking for a lower rate of return. So they'll have a certain percentage of their portfolio that be underperforming, and so they will buy some of those undesirable homes. And then finally, and maybe the most relevant reason is hedge funds provide an aftermarket. There's buyers. If you buy real estate in today's market, you're not going to have a shortage of buyers should you choose to sell. And it's, of course, at any time during the course of any investment, you want to have an exit strategy. At some point in time, you're going to want to sell your asset, regardless of what it is, and recoup your principal. Real estate's no different. And having these hedge funds in the market provides an aftermarket to buy. I pulled this off a year ago. This is still relevant to me. This was CNBC, March of last year, 15 months old now. But interestingly, this is what it said, and it's kind of proven to be very true. While home prices haven't hit bottom nationally yet, demand is starting to grow. Interestingly, we've bottomed out. We are no longer at the bottom end of the market. We are climbing back. We're certainly at a point now where the market's recovering. Certainly, demand did grow. And then it says especially for distressed properties at the low end of the market. Lori will talk a little bit about why Atlanta. But if you look at most specialized companies or hedge funds, they don't buy typically in Los Angeles or Orange County or San Francisco. They typically buy in the lower end of the market. There's a reason for that, and the reason is simply yield. You get a better cash-on-cash yield in some of the lower ends of the market. And then it goes on to talk about how large-scale investors like hedge funds, other private equity firms are rushing in with cash on hand. We've seen that now. We've experienced it. That is a true statement. These larger institutional buyers see real estate as the safest place to have your money invested. And so therefore, we've seen a lot of that money come into the marketplace. And then finally, this sort of frames the conversation we're going to have today. So how does an individual investor without extra cash get in retirement funds? And so the majority of the sales that we make as a specialized REO group is through qualified money. People with a 401k, a self-directed IRA. Brian's going to go through that in some detail today. He's going to talk about what AccuPlan does, all the great things they do to assist their clients in acquiring real estate or anything else they may choose to do with their retirement account. But that's where we see a lot of our sales. Folks realize, hey, I got money in an IRA or a 401k. It's a great way to take that money, invest in a piece of real estate, experience some cash flow. Maybe there's some tax benefits there, depending upon your situation. And then, of course, at some point in time, liquidate that asset at a high rate of return. So with that, that's a little bit of an overview on the real estate industry. I want to thank, again, all of you for being here today. I'm going to turn it over to Lori Graymont now with Summit Assets Group. Lori, again, thanks so much for being here.
Charlie, it's my pleasure. So, you hit on, go ahead.
Just once again, before we get started, Lori gets started, we're going to take questions at the end of the webinar because we had a number of people that joined late. So we'll be taking your questions at the conclusion of the webinar. And at the conclusion of Lori's PowerPoint, Brian Davis will be talking about AccuPlan and all the terrific services they offer. So with that, Lori, I'll turn it over to you.
Sounds great, Charlie. So you hit on a couple of things I hear a lot of investors talk about, and it's, they're worried about how are they going to get into the marketplace with hedge funds. And I just encourage people to embrace the fact that the hedge funds are in because they have helped the recovery. They sustain a price where you can be assured that prices aren't going to drop because they're still in the marketplace buying, and it takes them a while to stop buying. It takes them a while to make decisions. And so as an individual, I think it's just the prime time to get in. One of my economist friends always says, don't invest at the bottom and don't invest at the top. Invest on the trend. And since the trend is up, now is the time to invest. So Summit Assets Group, you know, we're an innovative real estate firm. We provide quality cash flow properties in Atlanta. And we've also opened another marketplace. We can talk about that in another webinar. We also provide note investments for our investors who want to earn on real estate but don't necessarily want to own it. And we educate and coach investors who want to be active in the marketplace. Since 2009, we have actually bought and sold over 1,400 homes. I personally have been involved in real estate my entire life. I'm a host of Real Estate 360 on the Wall Street Journal radio, as Charlie mentioned. And so I share a lot of my experience, my education. Unfortunately, education often comes with a price tag of experience, and sometimes it's good and sometimes it isn't. And so I grew up in a family that would buy houses, rehab them, and sell them. Sometimes we got to move into them. Sometimes we got to just fix them without moving into them, which is always fun. And I've done just about every type of real estate, from land development to buying at auction. I bought a multifamily at auction. I've syndicated many different projects, and syndication is a term for raising funds for larger projects. So in 2010, I identified Atlanta as a marketplace that was behind the curve. When the rest of the market was falling and starting its recovery, Atlanta didn't actually fall. They started to fall about 6 months after everybody else. And then they started to recover. And so in 2010, we started doing all of our market research and buying in Atlanta when everything else was on clearance. And then about 2012, things turned around very quickly, but we've been there for a while. And it was pretty surprising to me, you know, how metropolitan Atlanta was. They have a population of 5.3 million people, and they've grown by 2.4 in the last 20 years, and they expect to grow another 2 million. They have a great educated working force, and the reason that it's important to understand if they're growing or shrinking, and if they have an education focus in their economy, is for jobs. You want to know, are people moving there? Are they employed? Are they earning money? Because whether you want to sell your home or you want to collect rent, both of those are going to need people and jobs. If you look at the rankings they received, they're the #1 rental market, the 4th best city to invest in, the 4th most affordable city, the 3rd for market growth, and they have the world's busiest passenger airport. They're home to 15 Fortune 500 companies, and they have a very diverse economic base. One of the things you want to look at when you're investing outside of the area you work in and live in is another economy that is supported by many different employment sectors. If you think of Detroit, you're going to think automotive. If you think of Las Vegas, you're going to think gambling. If those industries suffer, then the entire economy suffers. Whereas if you have a diverse, I usually say pick something that has 5 strong segments, and you'll have a safe economy. And that's what you see here in Atlanta. They have government, professional business, they have trade, education, and leisure and hospitality. The other thing that I look for in a market that I want to invest in is the marketplace, or is the government making investments in the local economy? Are they doing infrastructure? Are they bringing in things for leisure? And one of the things that's going on, there's tons of building. If you go to Atlanta, you're going to see tons of building. But one of the big projects they're doing is a $2.8 billion redevelopment project that's going to connect 22 miles of historic railways. They're going to turn those into paths. They're going to have 1,300 acres of parks. And the reason this is good is it's creating 30,000 permanent jobs and 48,000 construction jobs. the cost of living in Atlanta is really cheap. You know, if you were to go out to the suburbs, pretty much the areas that we invest in, you can get a nice 3-bedroom, 2-bath house that's about 1,300 square feet for $900 a month. You know, again, it's the 4th most affordable city to live in. And one of the things that also makes it good is that they are the first least costly for a business to start up. And so a lot of people are moving from the higher cost areas into Atlanta and starting up businesses because there is a highly educated population there. Atlanta has seen the rents increase now 4 years in a row. The average increase is about 4.5%. In Summit, you know, we come to the table with a lot of experience. There's 7 employees here that live in and around the Bay Area, and we have 40 team members on the ground in the Atlanta market. And what that experience does is it helps us to identify and avoid any known risks in investing. You know, we employ the best practices to avoid risk, and we're connected with the top professionals. So should a risk come up that was not anticipated, we can get the help that we need. So the way that the process works is we go out and we locate properties that will work in a turnkey situation. We determine first and foremost, will it rent? Because that's what the asset is being used for. We make offers conditional on inspections, and we go out and inspect it. If we decide to buy it, once we've purchased it, we set up curb appeal and we start marketing for a renter right away. And then while we're doing the repairs, we often get a tenant that's ready to move in. Now, before we actually move in a tenant, we pay for a property inspector to inspect the property and certify that it's rent safe. We rigorously screen our tenants. We want to make sure that they have 3 months of net income from the rent. So if the rent is $800, they need to be taking home $2,400, not just making that, because if they've got taxes and, you know, contributions to their retirement and maybe garnishes, they don't have that money to spend. And we want to make sure that they're going to have enough money to pay the rent. When we move the tenant in, we do a tenant move-in, and then we go back 90 days later, and we inspect the property to make sure that everything is still fixed and everything looks good, and that we aren't going to have any issues with the tenant. One of the services that we offer for our owners, and this is mostly because we're investors ourselves, and what we do is we call our owners. Some of our owners have asked us to email, but mostly we call our owners and we just check in every month. You know, have you received your statement? And then we ask the all-important question, have you read your statement? Because a lot of times our owners will get it in their email and they go, oh, I'm going to read that later, and then it's a couple weeks later and they still haven't read it. We'll go through the statement with them right on the phone if they like. We basically want them to be involved in their investment and know that it's performing, but we take care of everything else. We even have one of our guys on the ground drive by every property every month just to make sure that, you know, things are going well and that the tenant isn't doing auto repair in the backyard or something. The process to buy one of our homes is very simple. We do a 15-day escrow. Most of our buyers buy for cash. They oftentimes, like almost, I'd say 75% of our buyers buy with retirement funds, and so Brian's going to be able to help you understand how that happens. So we do a 15-day escrow. We require a deposit of $5,000 up front. We give you 10 days to decide. And if you decide at the end of day 10 that you don't want to do it, we return your money, no questions asked. And then we typically close 5 days later. All of our homes are sold with a home warranty. So we pay for the home warranty. Should something happen in the first year, it's going to be covered with home warranty. We also warrant the work that we do on the house. And you'll get a document that lists out everything that we did for repairs, and we warrant that. So basically, we act as your one-stop shop. You call us, you give us a question, we're going to take care of it. We're not going to say, oh, you need to call this person, oh, you need to call that person. We want to make it as easy as possible for you to have the property. So I wanted to show you just a couple samples of our properties. This is a property that is available as of today. It is rented. It has a current tenant in there. They've been there now for a year. And this house was built in 1954. It's nicely updated. It's got the hardwood floors. It's a 3-bedroom, 1.5 bath. And we're selling it for $55,000, and it rents for $7.25. Now, anybody that's on the West Coast looks at those numbers and can't believe that you can actually get a whole house. Yes, that's the roof, the walls, the plumbing, everything for that price. But it's real. It's a beautiful neighborhood, very owner-occupied, and it's a great cash flowing tool for you. So here's another property. This one was built in 1984. It's a 3-bedroom, 2-bath, 1,200 square feet, and this one rents for $875. Very nice open floor plan with the dining room and the living room. We have some other properties in stock. You know, if you have interest, you just need to contact us, because one of the things that we do is we consider what your plan is. We don't just hand out our list and say, here, pick one. We want to help guide you, because everybody's plan is different. So you need to know, what are you looking for? Are you looking for more on the income side, or do you want more equity growth? Are you a conservative investor, or are you more towards the aggressive side? Are you looking for short-term or long-term? And long-term, if you live in California, does not mean 1 year. Long-term is 3 to 5 years. Are you looking, you know, are you okay being a slumlord, or are you looking for pride of ownership? Do you want to pull out the pictures at a cocktail party and show everyone? Do you want single-family, multifamily? Are you more comfortable with syndication? And then you need to ask yourself, do you want to self-manage, or are you looking for professional management? All of those come into play. Most typically, the clients that work best with us are looking for growth of equity with cash flow as a balance. Their risk tolerance is typically conservative. They are investing for 3 to 5 years. They're looking for pride of ownership in a single family, and they're definitely looking for professional management. But we do have investors that have other preferences, and that's why we want to consult with you before we make a property recommendation. You know, our goal is that you have 0 headaches. So one of the things that I encourage you is to not wait another year. People have been in this marketplace, like we've been there since 2010. Prices still are 60 to 80% of replacement cost, and interest rates are low, but we've seen that they're starting to go up if you are going to get financing. Rents are expected to continue to increase, and there's a shortage of inventory. So right now, prices are still affordable. In Atlanta, there's less than 2 months of listed inventory. The banks are not foreclosing, and the hedge funds are pretty much buying above asking price. We all know there hasn't been any building now for 6 years. So the key for you to find properties at the right price that make sense is to work with people like us, where we have off-market properties. We don't list our properties on the MLS. We just work with our clients. And just a sample here, you know, if you were to buy one of our houses at $92,000, let's say it's 1,600 square feet. We just finished selling one that was at this exact price point. That's only $57 a square foot. And if you were to try and rebuild that home, it would cost you anywhere from $78 to $105 to rebuild it. So we're still below rebuild cost. And the reason I point that out is a lot of people are concerned, you know, are we overpriced? Is it too late to get in the marketplace? No, it's not too late. But the decision has to be made, and so that's what I encourage you to do. I have my contact information and Charlie's contact information here, and I want to thank you. I think now Brian is going to share how you can use your retirement funds to get into an opportunity like this.
Thanks so much, Lori. Brian, we're going to hand you the controls.
All right. Everybody see my screen okay?
Yep.
So, well, thank you, Charlie. Thanks, Lloyd. That was a lot of great information. Now, the second time I've heard your presentation, and I picked up a couple more things this time. So thanks for having me on the call today. My name is Brian Davis with AccuPlan Benefit Services. Little disclaimer, if my computer wants to work. Oh, come on now. Give me 1 second here. Sometimes happens when I'm working on GoToWebinar. All right. So a little disclaimer before I move forward that we are not financial advisors. We are third-party administrators and help people direct their retirement accounts to what they decide to invest in. So AccuPlan, we specialize in people that want to self-direct their 401ks and IRAs to the alternative investment marketplace, namely real estate. So for those of you that don't know about it, you're not alone. In 1974, Congress passed the ERISA Act, which outlined today's 401k and IRA structure that we see today. The industry is dominated by banks and insurance companies that specialize in securities, stock, bonds, mutual funds. When the IRS wrote these rules, they let into place, when you have a custodian, you can invest in just about anything. And those custodians, they specialize in those securities and annuities, so they don't work in the alternative asset marketplace. At the end of 2010, there was $4.7 trillion just in IRAs. That's not including 401k plans and pension plans. 98% of that was with traditional assets in the stock market and the fluctuations that go with it. Last year, when Mitt Romney came out that he had a $100 million IRA, it was kind of a big visibility boost to our industry, showing that, hey, there's other things to do with your retirement account besides letting the stock market run you which way it's deciding to go that day. So for those people that like to invest in real estate, it's a great opportunity for you. So what we're seeing mostly at AccuPlan and all of the self-directed IRA custodians for that matter is people mostly investing in real estate, in loans, buying notes, investing in private businesses, and even precious metals. I don't see the precious metals person so often. I'm mostly seeing real estate. And right now, as Lori just went through, it seems to be a great time for real estate. Again, you can invest in almost anything, as you see here: tax lien, foreign real estate, oil and gas, you can joint venture, private placements. The list can go on and on and on. The IRS never made it a list of approved investments, just what you can't invest in. And there's really only two things your IRA can't invest in, and that is life insurance contracts and what the IRS deems as a collectible. And there's some examples on this screen here: a work of art, a rug collection, stamps or coins, and there's even some exceptions with certain precious metals. Another thing you'll often hear is S-Corps. That's an S-Corp rule that IRAs can't invest in S-Corps, not an IRA rule. But an IRA can't invest in an S-Corp. The second part of the equation you want to worry about now, you know, okay, I can invest in pretty much anything. What other rules are there? And the one thing you want to look out for are what's called a prohibited transaction. A prohibited transaction is when your IRA gets involved with a disqualified person. The basics of this is there's no self-dealing. And this can be looked up if you want to look up and Google IRC 4975, that stands for Internal Revenue Code. And it talks about disqualified persons and prohibited transactions. And here's the highlight. No self-dealing between your IRA and yourself, your spouse, your parents, grandparents, children and their spouses, grandchildren and their spouses. So you kind of want to think of it in a straight line up and down. Those people your IRA can't invest with, or a company in which they're the majority owner of. And if anybody has any questions about this, this is kind of the things to watch out for portion of the show. Feel free to write a question or contact me after the webinar. So I want to play a little game here. And hopefully everybody remembers Deal or No Deal from TV a couple years back. So let's look at it. Let's look at a couple deals here. Let's say your IRA wants to lend you $10,000. Deal or no deal? That one's pretty obvious. That one's no deal. That's self-dealing. You can't lend yourself $10,000 from your IRA. But what about your brother? Can your IRA lend your brother $10,000? Deal or no deal? That one's a deal. He doesn't fall in that category of being straight up and down. He's on the horizontal path. As I like to say, I don't make these rules. I just help people live by them. This one's a little tricky. Your stepson. Can your IRA lend your stepson $10,000? That one's deal. If it was your son, it would be no deal, but the IRS has said stepson is okay. Again, a little quirky, but these are the rules. And daughter-in-law, $10,000, deal or no deal. This one is no deal, your children and their spouses. So again, if you're not used to these types of investments, it can be a little quirky. The great thing about investments like the one Lori's presenting, they're most definitely going to be third parties in these in these assets that they're selling in Atlanta. Next thing I always get asked, well, how do I put money into a self-directed IRA? I got a Roth and I got a SEP. What do I need to do? Well, self-directed is really just a marketing term. It refers to the fact that you're allowed to direct your investments into everything allowable under IRS guidelines, and you're not limited by your brokerage or insurance company. So if you have an existing IRA, we do what's called a trustee-to-trustee transfer. We'll move your cash from your existing IRA custodian and whatever type of IRA it is in there to an IRA with us and allow you to direct it to investments of your choice. If you have an old employee plan like a 401k or 403b or pension plan, you'll want to do what's called a direct rollover over to AccuPlan and our custodian, American Estate and Trust. This will put the money into a new IRA and allow you to self-direct. And then the last option here is making annual contributions to your plan. Most people fall into the category, if you're a W-2 employee, of having a traditional or Roth IRA. You're limited on your contributions of $5,500 a year. If you're over 50, you can throw in an extra $1,000. For the self-employed individuals, there's a self-employed pension plan that's very popular. It works very much like a traditional IRA, as it's a pre-tax IRA. It allows you to put in up to 25% of your income with a cap at $50,500. If you have employees, you might have to match them if they decide to opt into the plan as well, so something to look out for. And there's also a simple plan, which some small businesses have, which works similarly to a 401k, but it falls under the IRA guidelines, and the limits are a lot smaller than a 401k. The final plan I like to talk about that we administer is the individual K. You'll hear it called a solo K, self-directed 401k, a bunch of different names. So what it is, for the self-employed individual that has no W-2 employees, you can have your own 401k plan. So you can make contributions as the employee and the employer. So it's a lot easier to make large contributions compared to all the other plans. And the fact that it's a 401k plan, there's some extra benefits, including taking loans out against it that I'll talk about in just a second here. The main thing I want to talk about here, the difference of these retirement plans, is the difference between some of the pre-tax IRAs, like a traditional IRA, and a Roth IRA. So most people are familiar with the traditional IRA. That's generally what they have. They probably had a company plan, and they rolled it over into a rollover IRA. And generally what that just means is it's a pre-tax, it's a traditional IRA. So how that works, just like when you put your money into the plan, you're either able to write it off as a tax deduction if you're making a contribution, or if it was through a company plan that came out of your pay before you paid taxes on it. That's going to grow tax deferred. So it's not going to pay taxes while you're doing transactions in it, but when you take those funds out of retirement and the IRS starts forcing you in these plans at age 70 and a half, you'll have to pay taxes on that as earned income at that time. So they've created a kind of a separate IRA. They call it a Roth IRA. And this works a little bit different. When you make your contribution to the plan, you've already paid taxes on the money, so you're not getting a write-off on it if you're making a contribution. Or if you have a 401k plan that has a Roth deferral option, the funds did not come out pre-tax. You'd already paid taxes on it and made the contribution. And if you have an existing pre-tax IRA and you want to convert that to a Roth IRA, you would pay taxes on that during the conversion. The benefit of this is it's going to grow tax-free. So if you're able to find an investment that's going to have potential large growth, it might be a great plan for you to look into and look to possibly converting your IRAs to a Roth. Another benefit is when you reach age 70 and a half, you're not forced to take distributions from the plan. You can even continue making contributions. So those are some highlights of the Roth IRA. And again, going back to the self-directed 401k, works very similarly to the IRA method, except for the plan is what's called a self-trusteed plan. So unlike an IRA that has to have a custodian to sign off on everything, the solo 401k is built in that the control is in your hands because you are the trustee of the plan. So you can directly make investments from the 401k plan yourself. You just have to get a 401k plan that allows for alternative investments, and that is what we help provide you here. So it's pretty simple. Whether you're incorporated or not, you can create the 401k plan. If you want to include all of your pre-tax old 401ks or IRAs, you can move them in there if you'd like, and then, or just make contributions and then direct the investments. A lot of people will set up a holding company or a trust to buy the investments, but that's not needed. And again, I can talk about this with anybody that has any questions on it. The 401k, you can loan money to yourself, just like a company 401k. You're a participant of the plan, so you can potentially loan yourself up to $50,000 and then have to pay back your own retirement plan with interest, so you don't have to borrow from the bank. If you wanted to go maybe buy a car or buy a property or something, you could actually borrow it from your own retirement plan and pay yourself back. So those are some of the highlights of that. The IRA, which most people fall into, very simple. We can get your account open within minutes. We have an online account application form. Then we work on funding your account, whether it be a transfer, rollover, or contribution as discussed, and then direct us to fund the investment. We're generally 24 to 48 hours on moving the funds from our account to the investment. The part that takes the longest here is funding the account. So I know that Lori said, you need to have that money there and make a decision within 5 days. So you really want to look to open your IRAs, get some money in them now, at least a part of it, and then when you're ready to make your purchases, those funds are there, because it can take up to a few weeks to get going there. So again, you're not limited by what your stockbrokers and financial advisors and planners are telling you. You can invest in these alternative assets and take advantage of this real estate market that we're all in right now. That's what I have for you today. Here's my pretty face. I'm Brian Davis with AccuPlan. My email address, briandavis@accuplan.net, and my cell phone number there. Please feel free to contact me with any and all questions of the 401k. And Charlie, Lori, I'll let you guys open it up to questions.
All right, sounds good. Thanks so much, Brian. Again, I learn something every time you do that. I'm going to be an expert one of these days. Okay, we've already got a couple questions here, and one was just to compliment on the professionalism of the webinar and to ask if this is recorded. Yes, this webinar is recorded. If you'd like to get a copy of it, you can email myself, Brian, or Lori. We had another question saying that we went too quickly with Lori's phone number on the screen. So if you would like to write down Brian's information, we'll leave it up here for a second. Then I'll switch the screen, and we'll put up Lori and my contact information on there. So yes, with that, Brian, thanks so much. Lori, thanks so much. We'll open it up for questions now. Again, if you look to the right of your dashboard, there's a little button that says questions. If you just click on that, your screen will drop down, and that will enable you to type your questions into the box. So I'll just hit my mute button here, see if we get any questions. Okay, so there's our contact information there. If you'd like to contact myself or Lori, you're more than welcome to give us a call. And I have no questions in the box at the moment. So we'll give it another minute here, see if any questions pop up. If not, we want to thank everyone for being on today. We'll be doing another one of these in about 2 weeks. We haven't scheduled it yet, but we'll be doing one. Actually, it's not 2 weeks. We're going to be doing one the week after the 4th of July. So be on the lookout for that webinar. And again, this broadcast was recorded. So if you'd like to have a copy of it, just give us a call. Okay, Brian, we got a question for you. What are the fees to manage a self-directed IRA?
Self-directed IRA, we have a one-time setup fee of $50 and a flat annual fee of $275 per year. Those fees can come out of the IRA funds or you can pay them yourself. Beyond that, we charge $15 for wires, and you get 6 free transactions in your account. After 6 transactions, which is buying an asset, there's a small $35 transaction fee.
Okay, another question here. Do you presently have a portfolio of real estate in Atlanta, and what cap rates are you finding?
So Charlie, I assume that one's for me.
I assume that one. I think we both could answer that. Why don't you go ahead?
Yeah, so we have a portfolio there, and the cap rate varies. I mean, we used to be able to get about a 10%. We're down to about 8% now. Very strong rental market. Things rent like, just even before we're finished with the rehab, things are renting. So it's a very good marketplace.
And what I'll do, too, is I will email you, the individual that asked that question, I will email you our current inventory just to give you an idea of what some of the inventory currently looks like there. Next question for Brian. Could you go over the conversion process from a 403B to a Roth IRA?
Okay, so if you had a 403B plan at your work, you probably work for the state or for a hospital or something to that regard. So you're going to have to work with your plan administrator to do a rollover. So what we do is we open up a temporary traditional IRA, and we will write a letter of acceptance saying we'll accept the funds. You'll have to work with your 403B administrator. They generally take a couple weeks, and they'll mail you a check made out to the name of the IRA. We'll move it over to the traditional IRA, and if we want to convert it to a Roth, we'll open up a Roth account and convert the funds as soon as we get the funds over from the 403 plan.
Okay, next question, Laura. I believe this will be directed to you as well. I'm sorry I missed some of your presentation. What about multiple units or apartments, et cetera?
So we mostly focus on single family. We occasionally get in duplexes, fourplexes, triplexes. We don't really go after much that's larger than that just because that's a whole different animal. And right now it's not really the right timing. I think probably in another year it'll be time to get into the apartment buildings.
Okay, Lori, for you again, what is the typical price range for a single-family resident in Atlanta? And again, I will send you that asked that. I've got your name here on the screen, so I will send you the inventory list so you can look at it. But Lori, go ahead, you can answer that. What's the typical price range for single-family residences in Atlanta?
Charlie, there isn't a typical. It kind of comes down to what type of investment you're looking at. So we kind of classify the neighborhoods A, B, and C. A neighborhood is a nice neighborhood, somewhere you'd feel comfortable living. B is a working class neighborhood, again, somewhere you'd feel comfortable living. C is a neighborhood where it's a little bit lower income. You may feel comfortable there, but you may not, just because there's some homes that aren't cared for. But the reality is the rents are much higher, so you're going to get a lot better cash flow in the C neighborhood than you would get in your A neighborhood. Your A neighborhood, your cash flow is going to be minimal. You're going to see maybe a 6% return versus a 10 or 12% in the C neighborhood. Now, the C neighborhood is nowhere near what we would call the hood or anything like that, but it's just one of those neighborhoods where you come into it and you go, okay, I can see why this would be a C neighborhood. Homes in that neighborhood are going to be in the $40,000, $50,000 range. Homes in your A neighborhood are going to be in the $100,000 to $200,000, and then the B is going to be anywhere from $60,000 to $100,000.
have nothing else for the moment. We'll give it another minute here. We'll leave our contact information on the screen. For those individuals that ask those questions about available inventory, I will send you out our latest list. What you might want to do is after you get a chance to look at it, just give me or Lori a call and we can discuss the particulars with you. Okay, another question for you, Lori. I know the answer to this, but I'm going to let you answer it. Do you have solid management companies in place and tenant selection can kill you? Very good comment.
Yeah, so a lot of people spend so much time focused on the purchase. It's sort of like when you're having kids, so much time is, and so many books are written on the pregnancy, and they kind of forget about the long endurance of holding the property or having a child. And that's where you're going to make your money or you're not going to make your money. So we have got an excellent team on the ground. We partner with them. We're in a joint venture with them. And so my clients are my clients. I get to protect them. I get to stand up for them. I overwatch or oversee the management company managing your properties. And, that's a real value to you because I also have got properties there. And if they're not taking care of you or they're not taking care of me, we go find a different property manager together. And by our numbers, we have got, some power there. So yes, we have got great property management.
Got another question. What type of financing is available for houses purchasing through a self-directed IRA? How much of a down payment would typically be required?
So
you want me to take that, Charlie, or you want Brian to?
Do you guys have a in-house non-recourse lender?
We do not.
Okay. So
actually,
generally what I'm seeing, I'll let you go, Charlie.
Yeah, just real quick. We actually do have a non-recourse lender, but I got to tell you, and the reason we do is simply because we have been asked multiple times on these webinars about financing, and so we actually made an effort to go out there and find what we thought was a reasonable non-recourse lender. And we did identify one, but I have to tell you something. The fees are I think, ridiculous. When you look at buying, let's say you're looking at buying a D-type property, let's say a $70,000, $80,000, $90,000 property. You're going to pay at least $5,000 in fees. You're going to pay interest rates that are not equivalent to what you get on the market today. They're not going to finance the entire price of the home. They're going to finance a percentage of the home. To me, it just doesn't make sense. We have not done one transaction with a non-recourse lender simply because when somebody adds those numbers up and they look at what they're buying and why they're buying it, it just doesn't make solid sense. So financing really isn't something. If you're going to finance something, I'd recommend you go get take a second on your home or something and pull cash out of it, or borrow against your 401k or your IRA, or something along those lines versus working with a non-recourse lender.
Yeah, with these purchase prices with those fees, it sounds kind of high, and they generally require, nationally 35 to 50% down in reserves. Then your IRA has to make the payments on that, and then your IRA is subject to a possible tax. So it can be a little bit more trouble than it's worth, kind of as Charlie's mentioning here in this specific situation. In other situations, it can make a lot of sense.
Yeah, and the fees are really prohibitive. It's just really, when you add the numbers up, it just doesn't really make a whole lot of sense. Okay, I think that's the end of our questions, folks. Lori and Brian, thanks so much for being here today. I want to thank everyone for being on today's call. Again, we got our numbers on the screen. You can give us a call if you got any other questions. And we just want to thank you all for being here, and we look forward to seeing you all next time.
Thank you. Bye.
Thank you, Charlie.